Hi guys, welcome to the A Plus Trading channel. Now in today's video we'll be covering the different Forex sessions and understanding the different types of traders. Without further ado, let's get started. Forex market is a market that is open 24 hours throughout the day and is divided into what we call Forex sessions. So even though the market is open 24 hours a day, the market only closes Friday 6 p.m. Eastern Standard Time and opens on Sunday 6 p.m. Eastern Standard Time. But otherwise from that, the Forex market is open 24 hours a day. However, it is divided into sessions, three major Forex sessions. So it's up to you to decide which session would I feel comfortable trading and why would I like to trade that session. Alright, so as previously said, Forex trading session is a session that divide the 24-hour market period, and they consist of three manageable trading periods. Traders usually focus on one of the three trading periods rather than attempt to trade the market 24 hours per day. So this is why it is important to know the different trading sessions to identify, all right, which trading session should I focus on? Which trading session is best for me to trade? All right, so similarly, where you have a day, a day is categorized into four, where you have the mornings, afternoons, evening, and night. So the day is split up into four categories. It's the same with the Forex market. It is open 24 hours, but it is categorized into three major trading sessions. All right, so what are these three major trading sessions? Now we have our New York session, our London session, and we also have our Asian session right here. And our Asian session consists of our Tokyo and Sydney. All right, so these Forex sessions and their time. So the Asian session, which contains the Sydney and Tokyo. So the Sydney is open 4 p.m. to 1 a.m. and this is in Eastern Standard Time. This over here is in Greenwich Meridian time frame. Alright, so the time for each Forex session would differ based on where you are in the world. So if you're in a different country with a different time frame, then you just need to find the time frame for these Forex sessions. You can just simply do a Google search and you can get this information based on the time period you're in. Alright, but for this video, we are just using the Eastern Standard Time and the Greenwich Meridian time frame. Alright, so the Sydney market is open 4 p.m. to 1 a.m. and this is 5 p.m. to 2 a.m. Greenwich Meridian time. The Tokyo session is open 7 p.m. to 4 a.m. Greenwich Meridian time. It opens 8 p.m. to 5 a.m. London session is open at 2 a.m. and closes at 11 a.m. Eastern Standard Time. And in Greenwich Meridian time, that would be 3 a.m. and closes at 12 a.m. Now, the New York session opens 8 a.m. Eastern Standard Time and closes 5 p.m. Eastern Standard Time. If it was in Greenwich Meridian time frame, it would be open 9 a.m. and closes at 6 p.m. Alright, so the importance of each Forex sessions. Why do I need to learn these Forex sessions? What is the importance of these Forex sessions? So as previously mentioned, even though the Forex market is open 24 hours throughout the day, you would need to see which trading session would I focus on, because are you going to trade all these trading sessions, right? Or am I going to focus on one trading session and trade during that time frame because that matches with my goals, that matches with my schedule, that matches with, everything that I want out of trading. So you need to know that, and based on the information at the end of this video, you should decide which trading session is best for me, based on even my trading style too. Which trading session do I need to trade? All right, so we're going to touch on the importance of each Forex session, and the first important one we have is movement in price, which is our pips. So I've explained pips in detail in our previous beginner's guide to Forex of what is Forex. So you guys can definitely check that out if you haven't watched. So the reason why the movement in price or pips is important, remember, if you buy a currency pair and you're expecting a rise. So say for instance, you buy a currency pair at $12, it rises to $14, it moved up 2 points, or it moved up $2 from where it was. So that difference in price movement would be what you would have profit from. So if you're trading a particular session, you want to trade a particular session that has the most movement in price, so I can capitalize on that movement in price. I can capitalize on the fluctuations in prices whether it is depreciating or appreciating. That is what I want to capitalize on. And these here on our left show some currency pairs here. So we have the Euro USD, and we're seeing here on average on the Asian session, Euro USD moves 76 pips. During the London session, we're seeing here it moves 114 pips. During the New York session, Euro USD normally moves 92 pips. All right, and this is on average because based on activities that happen throughout the day, these numbers may depreciate or appreciate, but this is just an average. So pound USD, we're seeing right in the Asian session, it normally moves 92 pips. London session, it normally moves 127 pips. New York session, it normally moves 99 pips. USD JPY normally moves 51 in Asian. In London, normally moves 66. And in New York, it normally moves 59. And these are our major currency pairs. As you can see, it contains the USD in it. So AUD USD normally moves 77 pips in Asian, 83 in London, 81 in New York. New Zealand dollar USD 62 in Asian, 72 in London, and New York 70. USD CAD we're seeing 57 in the Asian, 96 in the London, 96 in New York. USD Swiss franc we're seeing 67 in Asian, 102 in London, and 83 in New York. Alright, so what's the importance of this information right here? Alright, if I want to catch the most moves possible, which session would be a good session for me to trade? Well, based on what we're seeing here, the London session has a good movement in price. So if I'm a trader looking to capitalize on the most moves possible, probably in a short space of time, then the London session would be good for me. Alright, the second session after that would be the New York time because there's a good amount of movement in the New York time as well. Asian is a bit slow, so if you place a trade, you're not expecting a big move in a short space of time. Gradually takes it time to move. Alright, so that's one of the importance. So based on this information here, you might say to yourself, which trading session suits me best? Which trading session would I like to trade based on my schedule, based on my availability, based on my time? Alright, so a next thing that we want to note here is volatility per hour. So this is a Forex session chart and it's showing our volume here. These are our times in different time frames, our sessions here. This is Greenwich Meridian time frame, Eastern Standard time frame. But the thing we want to focus on most right here is the volume right here because you're looking at the volatility for each or throughout each Forex session. So we're seeing right during the Sydney and Tokyo, the volume is a bit low here, right? So as previously on the slide, we see right there's not a lot of movement in the Asian session. And guys, remember the Asian consists of the Sydney and Tokyo. So naturally, if there's not enough movement during that or there's a small amount of movement, the volume is going to be low. Now heading over here, we're seeing where the London session starts right here. And we're seeing where this is a good amount of volume right here, right? So there's a peak in volume during the London session right here. And we are also seeing that reflecting in the movement in pips chart that we previously showed that during the London session, you have a lot of pips, a lot of movements happening, right? And we're seeing we kind of dip right here. Then it starts to go up, but you can see that it is even more than what is happening in the Asian session, right? Touching to our New York session, we're seeing where volume is high as well. At the opening, you're seeing where volume is high, then volume takes the time to decrease in the New York session. Now, a quick thing to note about sessions is that whenever you have a crossover in sessions, there is always an increase in volume. So the reason why this is peaked right here is because the New York session started and the London session is still happening. So there's a crossover between two sessions. That's where most volume is situated when there's a crossover in the sessions. So you can see right here too, there's a crossover in sessions. That's where most of the volume happens, right? So that is something to note, and this is something we want to note when choosing our Forex sessions to trade. Do I want to trade when a crossover is happening so I can get the most volume and the volatility happening? Do I want to trade when it is much slower? So these are the questions you have to ask yourself to choose which session would work best for me in this scenario. All right. So, with that being said, with those two explanations of the importance of the Forex session, where we analyze the movement in price during those Forex sessions, we have discussed the volumes during those trading sessions. Now, what we want to touch on is the type of traders, because the type of trader is going to help us with which session is good to trade. We have four types of trader. We have a scalp trader, we have a day trader, we have a swing trader, and we also have what we call a positional trader. Scalp trader holding trades for only seconds or minutes. Day trader holding trades for up to a full day. We have swing traders holding trades for multiple days or even weeks. And we have positional traders holding trades for several weeks, months, or even years. Alright, so the first one you want to look on is scalper. Now, a scalper is a fast-paced trading style where traders aim to profit from small price movements by executing numerous short-term trades throughout the day. Scalpers typically hold positions for a few seconds to a few minutes and rely on technical analysis to identify entry and exit points. Their main objective is to grab very small amount of pips as many times as they can throughout the busiest times of day. Now, based on this definition, we can see where the scalper is more likely to trade sessions such as London and New York, because here it says that they would like to grab very small amount of pips as many times as they can throughout the busiest times of day. We have seen where the busiest time is during the London session, where that is where the most movement in price happen, the most movement in pips happen. So if the scalper want to grab the most pips in a short space of time at the busiest time of day, the London session will be perfect for them. The New York session is also going to be perfect for them, as those are the sessions that you have the busiest times. All right. So with a scalper now, that is a very fast-paced trading style. So they are in the market for just a couple minutes, couple seconds, and they are looking to benefit from the smallest movement in price. And they execute a lot of trades throughout the day. So there's in trades, out trades on a short-term basis. Now this have its advantage and disadvantages, and we're going to touch on the advantages and disadvantages of being a scalper. Now the pros and the cons. Like it provides many opportunities to leverage small changes in the price of a stock or even the price of a currency. So the smallest movement in price, they can benefit from this because it provides many opportunities for them. The con is requires greater leverage to make a profit, because think about it. If you're going to grab the smallest amount of moves possible in a short space of time, the market is not going to move like 40, 50 pips in just 1 minute, right? We're not going to move that fast in such a minute. So what you'd probably having is the market moving like 3 pip in a minute or so forth, right? So for me to profit off that small move, that means I need to have a greater leverage, right? I need to be a lot of lots in that currency, right? I need to be going in heavy, so the smallest movement in price would give me a large sum of profit, right? So that is the con, because here what the same opportunity you have to make money is the same opportunity you have to lose money. So if one small move in my direction will give me a good sum of profit, that means a move against my position would give me the opposite, which is a loss in my position or a great loss to my account. So that is also a disadvantage of a scalper. The next pro that we want to touch on, it can be very profitable if it's executed precisely and with a strict exit strategy. So scalpers can be profitable if they master their skill and it can be done properly. It can definitely be profitable and navigate the markets good. And next disadvantages can be a time consuming strategy that requires high levels of concentration. Yes, it can be time consuming because remember, you're trying to profit off seconds and minutes in the market. So you have to be thinking critical. Okay, what is the market going to do in the next 1 minute? What is the market going to do in the next 2 minutes? So your concentration level has to be high because you're just predicting the market for a small amount of time frame. It's not like you're doing predicting what's going to happen in the next hour or what. You're going to predict what's going to happen in the next second, the next minute. Do I need to place a trade? No. Do I need to watch for a structure to do something? What do I need to do? So it takes a high level of concentration to be a scalper. The pros, you don't have to follow basic fundamentals. No, fundamentals is basically news, data, and so forth. So you don't really have to follow those because you'll not be affected by those information if you're just going to be in the market for just minutes, seconds. So things like basic fundamentals would not have any effect on you because you're just going to be in the market for a short space of time, right? Just going to be profiting from those small moves. So you're not going to have a wider outlook based on fundamentals. For example, if a war is happening, those basic fundamentals do not concern you as you're just only here to just be in the market for a couple seconds, couple minutes. Disadvantage of being a scalper is high transaction cost for participants. Now, as we previously mentioned in our beginner's guide part 1, where you have what we call spread, that is the broker's fee that you take for each trade, right? If you're taking multiple trades in a small amount of time, that means you're going to pay a high transaction cost, whereas someone who would take more longer term trades and so forth. So that is the disadvantages of being a scalper. Now we're going to touch on our next trader right now, which is our day trader. Day trading is a style where traders open and close positions within the same trading day. So I'm just interested in a 24-hour mark. I'm not interested in having my trades open for another day or so forth. I'm just interested in what's happening today, and I just want to trade my position today and close it today. Day traders may use a mix of technical and fundamental analysis to capitalize on intraday price fluctuations. Day traders usually pick a side at the beginning of the day, acting on their bias and then finishing the day with either a profit or a loss. These kinds of traders do not hold their trades overnight. So the day trader comes to the chart and he's determining a bias. Well, what do I think is going to happen at the end of the day? Will I think this currency period go up? Will I think this currency period go down? So if it's going down, I'm looking to sell. If it's going up, I'm looking to buy. It determines a bias at the beginning of the day. He sticks with that bias and he places a trades based on that bias. Then at the end of the day, he closes his position, win or lose. If it hits his target, he's out of the trade. He's not interested in holding his trade for another trading day. He's just interested in today. So we are going to look at the advantages and disadvantages of being a day trader. So the pros and the cons. So day trading strategies wait until there's a valid trading opportunity. There are less trade monitoring and management obligations. 24 hours in a day, you don't have to be on your laptop or your phone trading 24 hours for a day. So a day trader basically puts his trade on and completes his daily activities without checking back. At the end of the day, he probably checks back his chart to see where his position is at, or closes his position, or if he hits his stop loss, then he's out of the trade. So he go about his daily activities. The scalper, on the other hand, he has to be on the chart because he's just being on the chart for a couple seconds, couple minutes. So his level of concentration has to be high, right? Day trading, he just looks for an opportunity, determining his bias, place a trade, and he's on to his daily activities. The cons of a day trader. Now, because day trading strategies target distance prices, there's a high chance of failure, which this is very true, because think about it, right? If I'm doing a day trade, right, and I'm attempting to hold the trade for 24 hours, right? My distance where I want price to go would be higher than someone that was trading the market for just seconds, minutes, or so forth, right? I'm looking to target high levels. I'm looking to target key levels. I'm looking to be in the market for a longer particular time. Can result in a high chance of failure, because if a trader is anticipating a high price, say for example, the trader buys a currency pair at $12 and is expecting that within this 24 hours I want price to reach $50 by the end of the day, right? That's a high price to reach at the end of the day. So it can be a high chance of failure. Another pro for being a day trader is less sensitive to spreads and commission fees, which allows more flexibility when choosing a broker or trading account. So whereas the scalper is opening multiple positions, right, and being out in the market, in and out, opening multiple trades, the day trader only opens probably one trade throughout the day, right, or probably three solid positions or so forth. So he would pay less commissions fees because he won't be having multiple positions open to pay a lot of brokerage fee. So he's less sensitive to spreads and commission fees. Alright, a disadvantage of a day trader here we are seeing, because higher levels of drawdown are expected, a larger amount of capital is required to maintain positions, right? So remember, we're targeting high levels, so our stop loss placement will also be of high value too. So probably you're risking 100 US dollars to make 400 US dollars. You're risking 1,000 US dollars to make 2,000 US dollars, right? Based on the market, because you're going to be in the market for a longer period of time, right? So the day trader can undergo a larger drawdown than even a scalper, because the scalper, a lot of moves is not going to happen against his position. Probably his stop loss might be three moves against him and he's out of the market, four moves against him and he's out of the market. Whereas a day trader might have a larger drawdown where the market have to move 40 points against him to be stopped out. The market has to move 50 points against his position for him to be stopped out. So the next advantage of a day trader is there's time to think and plan before entering any new trade, which helps preserve confidence. So the day trader has more time than even the scalper. Remember, the scalper is making decisions in minutes, in seconds, and they're only interested in being in the market for a small amount of time. So the day trader has enough time to think out his trade. Has 24 hours to decide. He has time to build his confidence, to make his setup, to make proper calculated decisions to profit from the market. A disadvantage of being a day trader is while traders wait for distance targets to be reached, there's a similar chance of drawdown to occur, which is an uncomfortable situation. So this is basically tied in with point one here, where it's saying that due to the distant targets, you can undergo significant drawdowns, or price can even go in your favor and then, go against you. Just imagine you're up 1,000 US dollars, and then when you look, you have drawdown to 500 US dollars, till at the end of the day, when you look, you lost 1,000 US dollars, you lost a 500 US dollars, right? So yeah, that's very uncomfortable. Now the next trader that we want to touch on is the swing trader right here. So the swing trader is a style that involves holding positions for several days to a few weeks, seeking to profit from short to medium term price trends. Swing traders may use a combination of technical and fundamental analysis to identify potential entry and exit points. These type of traders can't monitor their charts throughout the day, so they dedicate a couple of hours to analyzing the market every night to make sound trading decisions. Alright? So the swing trader wants to be in the market for a longer period of time than a day trader. He's thinking to hold his trade for a few days to a few weeks, and and he's seeking to trade the short and medium term price trend, looking more of a long term basis, right? And they can use technical and what we call fundamental analysis. Technical analysis is analyzing the charts. Fundamental analysis is like analyzing economies, news, and stuff like that to plan your entry and exit points, right? So the swing trader, as you can see in the definition right here, this would be an advantage because he has more time than even a day trader to analyze his chart, to do his process, because he's planning to in the charts for days and weeks, and he doesn't have to check on his position every single minute, every single day, because he's planning to be there for days to a week. So we're going to look on some of the advantage and disadvantage of a swing trader. Now, swing trading requires less time to trade than day trading, right? So remember, we're on a higher outlook, right? So we don't have to be watching the market at the end of the day or so forth, right? Because we have a higher outlook on the market. So we don't probably have to check our laptop or mobile phone for probably even a day, 2 days, 3 days. It requires less time on the charts than a day trader who has to check his positions probably throughout the day or the end of the day, right? So this is a advantage of swing trading. Disadvantage is swing trade positions are subject to overnight and weekend market risk. So think about this. You're not sure what's going to happen tomorrow, right? You're not sure what's going to happen during the different sessions when the different sessions change over and so forth. You're not going to be sure what's going to happen over the weekend. When the market closes, you can have important news being announced. So when the market opens, then the bias changes and so forth. So these are risks that the swing trader takes, because he's in the going to be in the market for a longer period of time. He's subject to risk in change in market activities and so forth. This is a disadvantage of being a swing trader. Advantage of being a swing trader is that you can do part-time trading, because since you don't have to be on the charts that regularly, you can take a position, hold it for days, for weeks, then you can trade part-time. You can work your 9 to 5 while your position is running on your laptop, on your phone. You're not going to be checking your phone every minute because you have a medium outlook or a medium term outlook on your position, right? So you have the time to do other things rather than just sitting on the chart every day. A disadvantage is time in the market is very difficult, right? Because you have to be identifying trends, long-term trends, medium-term trends. You have to be analyzing the charts for hours and timing those moves, waiting for levels to be respected and so forth. So time in the market is very difficult. So you don't have many opportunities such as the day trader and the swing trader, right? Because you have to be waiting probably days for setups, weeks for setups to happen before you can place a position, before you can even have a bias on a trade. Potential for bigger gains when letting winners run, that's an advantage because you're holding your trades for a long period of time. So you just imagine you buy into an uptrend and the markets keep pulling back and going up in your direction, going in your direction, going up. Thus, you're trading with the trend. Similarly, if you have a downtrend and you're selling, you're trading with the trend. Once you let that trade run out and you are trading with the trend, then you have a higher potential to gain these profits, right? So that's an advantage. And a disadvantage is swing trades also have wider stop losses, so for potential for loss is huge. That is same for the day trader, but just imagine for the swing trader who is going to be in the market for days and weeks, is even at more risk of a drawdown than even a day trader. So this is another disadvantage of being a swing trader. Now, position trader. Position trading is a long-term approach where traders hold positions for weeks, months, or even years, aiming to capitalize on significant price trends. The swing trader is there for a few days to a week, but the position trader would like to be in the market for weeks, months, even a year. So he's capitalizing on those significant price trends. Now, advantage and disadvantage of being a positional trader. So longer term positions are less impacted by volatility risk as the focus is the larger trend. Alright, so you probably don't have to worry about those short-term news effect, right? Like a CPI data coming out tomorrow, PPI data coming out tomorrow. I'm really not interested in those news that are coming out for those 2 days or for this week only, because I'm planning to in the market for months, years, right? I'm not interested in the volatility during the London session. I'm not interested in the volatility during the New York session. I'm planning to in this trade for a month. I hear, right? So those small term effects does not have any effect on my position. A disadvantage of being a positional trader is holding a position open for a longer period requires more capital, and that is definitely true. Because think about it, if you're holding a position for a longer term to benefit from those large movement in prices, you'd have to have a good amount of money in your account to even put a stop loss so that if you're going to draw down, it's okay. So it requires a lot of capital to do position trade. Advantage is the combination of fundamental and technical analysis gives a broader overview than one method alone. The positional trader uses both fundamental and technical analysis to give them a broader overview. So they don't rely on one method, whereas the scalper who just rely on technical analysis is not interested in fundamental analysis. But the positional trader is interested in the broader picture, the long-term picture. He's buying into what he believes the future, right? Based on the technicals, based on the fundamentals. So he does not use one method to determine his choice. Disadvantage of a position trader is the initial analysis can be time consuming and requires two different skill sets instead of one. Yes, because imagine you're outlooking a currency pair for 1 month ahead, for a year ahead, right? That's very consuming because you have to be analyzing everything for those outlooks that you have set up in your head, right? Now, Advantage leverage means traders can open a position with just a fraction of the capital that investing require. And remember, leverage is basically use of borrowed money, right? So the positional trader has huge leverages. So he doesn't have to have the full amount of money in his account. He trades on leverage and he gets the amount of money that he requires, right? A disadvantage of a positional trader is while short-term traders can also find opportunities in range-bound markets, position traders need trending markets. Because if I'm out looking on a particular pair, right? I'm looking to trade with the trend. I don't want to see price just in a loop, not making market moves, not going in one steady direction. Is need trending market. So you can't just trade in any type of market as a scalper, as a day trader. He has to wait on perfect setups, right? To trade with the trend. You can't trade in the range bound market. So to sum up everything that we have learned in this video is identifying your trading strategy, a crucial step toward developing a personalized trading strategy that complements your strengths and preferences. No matter what style you choose, you have to make sure that it truly fits your personality. By understanding and embracing your preferred approach, you can create a sustainable and consistent plan that increases your chance of success in the market. Alright, so with all this information that you have learned today, you can now decide, alright, which session should I trade? Am I a scalper who is looking for the most moves in a small amount of time? Am I a person who is just looking to trade throughout the day, right? Am I a person who is looking to trade medium term, couple days to a week? You need to know what type of trader you are and which session would complement you best in this scenario, or the session would not matter to me any at all because my outlook is large. So you have to use these and tie it in with your personality to see which trading opportunity would fit you best based on your schedule, based on the amount of capital you have, and based on all these factors to determine which would be best for you. Alright guys, so this brings us to the end of our video right here guys. Alright, I hope you guys have learned something from this, and until further time, keep watching the videos, keep learning, and keep continuing to hold the faith as trading could be the next big thing for you. Until then, bye bye.